There's just 1 week to go until the Federal Reserve's closely watched September meeting. So where are the opportunities in stocks during these volatile times? I'm joined now by Ryan Larson, Head of Equity Trading at RBC Global Asset Management. Ryan, it's good to have you here. Welcome.
Great to be here, Scott.
So next Thursday is the moment the markets have been waiting for. What should investors be doing? How do you trade this next week?
Well, I think if anything, the last couple of weeks taught us that volatility is here to stay, whether it's the Fed or developments in China, overseas with emerging markets. Volatility will be here. So we're expecting this to continue up until their meeting next week. In terms of whether it's September or December, I think the main thing is that it's most likely imminent this year. I think the market's right to be pricing a less than 1/3 chance for September, about a 50 to 60% chance for December. Our bet's on December, and we would expect volatility even to continue through September if they don't hike into the December meeting.
All right, and if it is September, do you think there'll be an immediate sell-off right after?
Probably. I mean, if you step back and think, though, why the Federal Reserve is raising interest rates, it should be applauded, right? The economy is arguably in a much better position now than it was several years ago. The labor market's in a much better position. So the Fed, if they do raise in September, is thinking that the economy can start to withstand interest rate hikes on its own, and that should be applauded as opposed to cheering more stimulus from central banks.
All right, and we've been seeing some pretty large swings in the markets to the upside lately. I mean, is this a relief rally, or are the markets sort of just in this state of confusion ahead of the meeting next week?
Well, we think this is going to be a process. So if you go back 2 weeks to the extreme volatility we saw on Monday, this certainly will be a process. A lot of damage was done during that week. 1985 continues to be a very key level on the S&P 500. That represents the 50% retracement from the declines that we saw 2 weeks ago. So if you look at yesterday, for instance, we opened strong. We got as high as 1988. We failed to sustain that level. Market sold off. So we're not sure that this is actually a real buying relief rally. We think more of a short covering rally where shorts are covering in the morning. As those shorts get covered, they press the shorts again. It turns it into more of a technical trade.
All right, but there must be certain sectors that you like across the markets, perhaps on a more long-term basis, right?
Yeah, certainly for a long-term basis, consumer discretionary, healthcare, technology, even energy. If you look at the last couple of weeks, energy certainly has been one of the leaders to the upside. With crude trading above 40, 40 seems to be the line in the sand on sentiment. And with WTI, I think last around 44, I think people feel more constructive about the energy trade. So certainly energy is going to be a leader in the next couple of weeks if we can stay above that 40 level.
All right, and going forward, I mean, where do you see the S&P 500 going from here? What levels are you looking at by year's end?
Well, certainly for right now, short term, 1985 is going to be a key level. Longer term, though, I think we can get back to that 2050 level and possibly 2100 level. When you step back and think, like I said, the economy in the U.S. is arguably in a better position than most of the globe. So as this short-term volatility subsides a little bit about the Fed's first rate move and what happens or may or may not happen with policy development in China, arguably the U.S. is in a better spot. So when people start to think about fundamentals more, as opposed to stimulus from the Fed, that should push us higher.
All right, Ryan, we'll leave it there. Ryan Larson from RBC, thanks very much for coming in.
Thanks, Scott.
I'm Scott Gamm, and you're watching The Street.